Well, hello, everyone, and welcome. This is Cynthia Tomaine with Interactive Brokers, and thank you for joining today's webinar being brought to us or in conjunction with the Singapore Exchange. I'm very pleased to have Tariq Dennison with GFM Asset Management deliver today's presentation on beating the benchmark index, an update on how offshore investors can pick top Indian stocks. So with that, what I'd like to do is pass the controls over to Tariq, and if you'd all please join me in welcoming him here this afternoon. Hi, Tariq. Thanks for joining.
Hi, Cynthia. Great to be here. So good. I'm just going to pull up and make sure everybody can see my full screen here. View slideshow. All right.
Looks great. Thank you.
Thank you, Cynthia. As you might know, I've been looking forward to this presentation for a while now. This one is about beating the benchmark specifically in India. So as some of you may know, India is the most difficult to access big market, or you might say the largest difficult to access market. And the reason that I have this main slide here is to really give you an image of that. If you look at the parts of the world that are lit up at night, you will see the parts where you really see, of course, the populated parts of the US, the Midwest and the East Coast. You see Europe, you see parts of China, Japan, and East Asia, but really in Asia, the part that sticks out, whole country, is all of India. And if you've driven around India, you'll know that there are hardly any parts of India you can go to and not get out of your car and see at least some human beings, some civilization, and some commerce. So it's the size and opportunity and potential of that economy over the next decade and how to look at that on an individual name basis instead of on the whole index that I'm going to be talking about today. So before I go any further, like Cynthia, I'm going to need to show a few disclaimers. First of all, the disclaimer. And now we have one more disclaimer page by Singapore Exchange. Okay, good. Now that we have the disclaimers out of the way, some of you may have attended some of my earlier webinars. Some of you may not have heard of me before, but just a brief introduction. My name is Tariq Dennison. As Cynthia mentioned, I run GFM Asset Management. We are an independent registered investment advisor firm and Hong Kong licensed asset management firm. We manage client accounts on the Interactive Brokers platform. So Interactive Brokers is one of our preferred places for managing client accounts because clients can see their accounts on Interactive Brokers. They get all of Interactive Brokers' good reporting, low-cost execution, access to multiple markets across the world, but they get our expertise in actually being able to take care of it, especially when they're busy professionals who don't have time to log in and trade. We have been trading and managing accounts since 1998, so it'll be 21 years now and counting. Before starting GFM, I worked at a number of different banks around the world. So that included Commerzbank in London, New York, and Frankfurt. Bear Stearns was a good chunk of my career in New York. JP Morgan took over Bear Stearns in 2008. I then worked with CIBC in Toronto and London before coming out to Hong Kong. And I spent a little bit of time at Societe Generale in Hong Kong before starting GFM. I have a master's in financial engineering from the University of California at Berkeley. I am a visiting faculty at ESSEC in Singapore, where I teach fixed income and alternative investments. My main focus is the US-Asia corridor, which is one reason I am an American by my accent, as you can tell, but based out here in Asia, so I can see what I believe is the most important G2 relationship in the world. I am a IFPHK certified financial planner professional and a member of the Society of Trust and Estate Planners and the author of the book Invest Outside the Box, which you can see a picture of there. So about this presentation can broadly be broken down into two parts. I'm going to start off by just some big picture background of why India. Specifically, I'm going to name 10 statistics, some of which you might know, some of which you might not know, which should, at least some of them should impress you about how important India is as a market. I often say when looking at the top 5 markets that I look at, I use the acronym JUICE, J-U-I-C-E, for Japan, US, India, China, and Europe. And so India is a large market, but it is difficult to access, which is why out of those 5, it is one that is very, very often overlooked. But these 10 statistics I'm going to give you hopefully will convince you not to overlook India and to spend some time getting through some of that difficulty. I'm then going to be providing a makeup of what the India benchmark is. So chances are, if you are a foreign investor allocating to India, you've allocated through the MSCI Emerging Markets Index or MSCI India, or perhaps traded the MSCI India futures on the Singapore Exchange or an ETF somewhere. But I'm going to tell you what's actually in that index and why you should be interested in perhaps choosing some single names and taking different positions in others. What are the opportunities by sector? So for example, if you have a different view on banks versus consumer discretionary, that's important in a big diverse market like India. Now, for the second part of the presentation, we're going to go into the nuts and bolts, the mechanics that Interactive Brokers and Singapore Exchange is more interested in having me talk about, namely how these instruments, these single stock futures listed on the Singapore Exchange that you can trade in your Interactive Brokers account, how these instruments work and how you can use them basically to trade Indian stocks, even though you do not have Indian rupees, even though you do not have a residency or an account or an Aadhaar card in India. I'm going to demonstrate some strategies of how you can trade these single stock futures versus index futures versus an offshore fund or ETF versus onshore shares if you have access to them, or also comparing them to a P-note, which is the traditional way of accessing the onshore India market before each of these incremental steps. I'm also going to be providing some, at least one directional and one long-short strategy, and talking a little bit about risks and risk management that you might want to consider when trading the India market. So I promised you 10 statistics. Here is the first one, and this is, again, is probably the one that's going to least surprise you. This is about India's growth rate and how India is now the fastest growing large economy with a growth rate that's recently surpassed China's. This data is from the IMF, and you can go there and create lots of interesting economic charts, where here I've plotted the growth rates of China, India, and the United States. And you can see here, of course, that the U.S. is has been a relatively slow grower compared with China and India, which are, of course, large emerging markets. For for probably about the past 2 decades, we've often thought of China as the major grower. And the real statistic to think of there is China and India had economies that were about the same size in 1980. So within the lifetimes of many of us on this webinar, China and India's economies were the same size. Now China's economy is 8 times the size of India's. So that is, looking back, how China's growth rate was larger. So one of the things to look at is how will India's economy catch up with China's in the next 30 years. So looking at these growth rates, you can see for a long time, India's growth rate was below China's, but is recently surpassed China's, and there's a good chance, given how much further it has to grow, it will be higher than China's for the coming decades. That's statistic number 1. Statistic number 2 is demographics, is population. One of the biggest drivers of economic growth is population growth. We're going to be talking a little bit later about GDP per capita, but here it's important to look at just raw population. One thing that's often not talked about when talking about China's population is about to peak. If you look at this chart, it is going to be in 2027, 2 things are going to happen. First of all, China's population will top out at right around 1.46 billion, and then it will pretty much stay there, and it's likely to decline after that. This is according to Gapminder in the UN Population Review. There are other places where you can see similar statistics as well. After 2027, India's population is expected to continue growing up to about 1.6 or 1.7 billion. So by that point, you can see that far out. Within our lifetimes, the difference between India's population and China's population will be about the size of the U.S. population. And you have to go back quite a ways, but before it was that way in reverse. So that's going to be quite important when you talk about size of the economy. How many people are you spreading that economy over? The next statistic, which I think is quite remarkable, this one is from PwC, from PricewaterhouseCoopers. Their projection is that by the year 2050, India's economy will surpass the U.S. economy. So part of what we've looked at is on a purchasing power parity basis. This is different than using official exchange rates. On a purchasing power parity basis, China's economy is about neck and neck with that of the U.S. The argument that on an official currency, it's still got a ways to go is an argument that the renminbi is undervalued, but neck and neck, China's and U.S.'s economy in physical goods and services terms is about the size of the U.S. India's economy is still quite a bit smaller. It's less than half the size of the U.S. economy. By 2030, it's going to catch up and be more than half, probably about 2/3 the size of the U.S. economy and half that of China's economy. And by the year 2050, India's economy is expected to surpass the U.S. economy. Now, at that point, it would still be smaller than China's economy. It still has a way to go to catch up from the past 40 years. But to think of the Indian economy and the U.S. economy at parity within the next 30 years is another remarkable statistic that I think is worth keeping in mind when making long-term investment decisions. Now, going into why, how do we expect this remarkable economic growth? Once again, we want to look at demographics. Now, I'm not just looking at raw demographics. If you look at the history of population growth and population pyramids, 100 years ago, we would have thought, oh my gosh, large population growth, that would mean lots of poor people and lots of slums. And those of you who have been to India know that India still is dealing with some of those problems. If you look at the left part of this graph, you will see the countries that have the highest growth, not just in population, but in working age population. If you look on the right side of this graph, you will see the countries that have the biggest problems with this. If you look at one of the other big juice economies we talked about, Japan, Japan's biggest problem is that it is going to have a shortage of workers. It is going to have way too many old people and not enough young people there to actually do the work. The countries on the left side of this have the opposite problem. Now, arguably, when you're talking about 1 to 3% working age population growth, that is actually a healthy growth rate that can sustain, but not having too many jobs, but also not having too few workers to fill those jobs. India is not the highest on this list, but it is high enough to be in a fairly healthy rate. Those of you who've also followed some of my other writings know that I'm also quite bullish on Nigeria for similar reasons. Nigeria, of course, has other issues that we can talk about offline or another presentation. Statistic number 5 is probably one of the more dramatic ones when you think about how far India's economy has to go between here and 2050. So if you look at this chart, that looks at GDP per capita in purchasing power parity terms for each of these different economies. So this is G7 and E7. G7 are the 7 biggest, most powerful, wealthiest countries that you can probably think of: US, France, Germany, Japan. And then PwC also include what they call the E7. The E7 are the big 7 emerging markets, which includes the BRIC, Brazil, Russia, India, China, but also Mexico and Indonesia. And what it's comparing here is how does the standard of living in those countries compare now versus in 2050. So this is over a 35-year time horizon now. We've only got about 30 years to go now. The U.S.'s GDP per capita is expected to roughly double in that time. So it's expected to go from a little bit under $60,000 US per person per year to a little over $100,000 per person per year. So the American standard of living will roughly double. If you go all the way to the right and look at India, you will see that it is expected to go up 11-fold. So what this means is that the average Indian right now on a GDP per capita PPP basis lives on a standard of living of $2,000 US per person per year. And by 2050, that's expected to go up to $22,000 per person per year. So when we talk about the Indian economy and the US economy getting at parity, that's the fact that the average Indian will still only be living on about 1/5 the GDP that the average American will be living on, but it will have about 5 times as many people. So again, those are the statistics to keep in mind. Statistic number 6, and this is starting to get into why this is a stock picking presentation. We're talking a bit about services. So when we look at economies that go from being emerging economies and emerging markets to being more developed and more interesting economies to build stock portfolios in, we really have to look at evolution of the service sector. Now, you'll notice this chart is quite different than if I were to pull up a similar chart for China. The green line, which is the decline in the agriculture services sector, is one that we see in almost all developing economies and developed economies. If you look in the US, 200 years ago, almost everyone in the US was a farmer. And now, almost nobody's a farmer. Small farms are going out of business in the US. Same thing if you look in Japan, you look in China, you look in much of Western and Eastern Europe. In China, their development over the past 30 years has come largely from industry, it's come largely from manufacturing. They've become the world's factory. But the India story, it's a stereotype, but as you can see, it's borne out by the statistics. India has become one of the services capital and outsourcing centers of the world. There are all sorts of different services that we see being provided in the Indian market, from not just call centers and outsourcing, but also medical tourism, pharmaceuticals, and even some manufacturing work, contract manufacturing, that's being moved to China because of the trade war and because of other reasons. So it's this rise in the service sector, this orange line, which I think is particularly interesting when we look down at the single stock and sector level. Next, I want to start going into index composition. And what is it that you're actually buying when you buy, say, the MSCI India or MSCI China? And if you have a pension and it's benchmarked to an overall MSCI World or MSCI Emerging Markets, that breaks down into these two indices. Now, one of the things I find attractive about India is that India's sector breakdown is more diversified, in part because of that sector exposure than China's. If you look at China's, there are three dominant sectors, as you can see. There's financials, consumer discretionaries, and communications. And those of you who've paid attention to my earlier presentations on China know that the consumer discretionary and communication sectors aren't terribly diverse either. A large part of that consumer discretionary weighting is in two liquor companies. And the communication sector is dominated by three largely state-owned telecom companies. That's China. Now, when we talk about India, what makes up this big different sector breakdown? We have a much larger weighting in information technology, energy, consumer staples, and materials. These are all areas where the sector weighting in China is much more lopsided than what we see in India. In a later slide, I'm going to be breaking down some of these names. Now, one of my earlier statistics was showing how growth in India, economic growth in India, had just recently surpassed GDP growth in China. That may be a loosely related statistic to an equity investor. What really matters to us is revenue growth and, most importantly, earnings per share growth. This statistic, which you can also find on my website, oneworth.net, shows year-on-year growth in net income of weighted average of the stocks in the MSCI India index versus stocks in the MSCI China index. And again, we're not talking about rocket science, night and day difference, but we are talking about 200 basis points per year difference in EPS growth of Indian companies over Chinese companies. Now, when we go to look at valuation, that's one reason the Indian market is more expensive than the Chinese market, is because of this recent higher EPS growth and higher room for growth. But there is a reason for that valuation. The Indian market still has more room to grow than many investors see in China. Statistic number 9, and for those of you who are in any of the other 4 juice markets I mentioned, this is going to be one that you're going to be interested in. India has higher interest rates. If you are in Japan or Eurozone, anywhere where interest rates are negative, or even if you're in the US, thankful that the Fed didn't cut rates last night and that we're still sitting at 1.5% to 2%. India, on the other hand, their rate cut has gone from 8% to 6.5%. This is on the 10-year yield. What does it mean when you have positive or even high interest rates? There's 2 things there. One, India does have higher inflation than any other large economy, but also it has much more real growth. When you look at real interest rates in India are still positive, which may not be too much to get too excited about until you realize that they're negative in so many other places. So what this means is this is not necessarily a good place to buy highly leveraged companies, but it is a place where just by investing in the Indian economy, you can expect real rates of return. I know in other segments where there are credit funds, aiming at 15+ rates of return in India, and that's not even especially high. But even when you look at the Indian government, you're talking about 6.5% rates of return just on a 10-year government bond. That, of course, is related a little bit to the currency. Statistic number 10, I'm going to compare the 2 currencies, the currencies of China and India, the Chinese yuan renminbi versus the Indian rupee. If you just look at the past 10 years, you might not think there's much of a comparison because 10 years ago, when I first came to Hong Kong, everyone was looking at the renminbi as a one-way bet. It was only going to strengthen, it was only going to go up. Of course, within the past few years, we've seen the renminbi trade a lot more sideways, see a lot more volatility, devaluation in light of the trade war. That's getting it to catch up a little bit with how the Indian rupee has acted pretty much since 1971. The Indian rupee is one of the emerging market currencies that you consider a long-term depreciator, and that's one of the reasons its interest rates are so high. India simply had higher inflation and a managed currency, but still broadly looser monetary policy than China. What does that mean? That generally means that you probably don't want to own fixed assets like bonds in India unless you're really, really confident on inflation and currency forecasts. But if you are an Indian exporter, this is a great, this is a great statistic for you. Some of the names we're going to be looking at later are involved in the export sector or individual names that would benefit from a depreciating rupee. If you buy the whole index, you're not going to be able to isolate out that factor and choose names that way. So, on to single names. I didn't put all 50 names here, but pretty much what I did was I just pulled up a bunch of logos of some of the top names that you're likely to see both in the MSCI India Nifty 50 Index, and most importantly, 50 names that you can trade with SGX-listed Indian single stock futures. All of these names here are brands that you would probably recognize if you spent any time in different parts of India, and these are all names that you can trade single stock futures on the SGX. The reason that I wanted to show it here is to show not just the different colors of the logos, but to show what a wide variety of sectors we're talking about. Reliance, as you may know, you've probably seen in many, many different sectors. You may have gotten phone service from them. They're basically a conglomerate. Infosys and Wipro are very much in the software services outsourcing. Dr. Reddy is a pharmaceutical company. Maruti Suzuki is one of the local JVs making motor vehicles. You've got utilities, and of course, you've got banks. So as you would expect to see in many, many diverse economies, you don't even really see this level of sector diversification, say in Canada or Australia. So this is something we should expect to see more of as India's economy develops and as these futures get more liquid. Going down on the spreadsheet on a name-by-name basis, you've probably recognized some of these names as names that you've been able to trade in other ways, in other markets. So one of the things I wanted to highlight here is if I sort these out by market cap or by weight in an index like the MSCI index, what sector are they in? Which of these do they have SGX single stock futures in? And just as importantly, would you be able to trade them any other way? So these are the top 50 names. You'll see all of them except one, except for Nestle India, have SGX listed single stock futures. Many of them, but nowhere near as many of them, do have ADRs or GDRs, EDRs listed in London. So there are ones that you can trade in other ways, but you have more selection of names through single stock futures than you do through the ADRs and GDRs. So if you're interested in a name like a Reliance or an Infosys, yes, you can trade it in an ADR or GDR or single stock future. And I'll show you some strategies of trading or arbitraging one versus the other. But some of the other names down here, the single stock future is really your only way of accessing it if you don't have an FPI license or a local Indian account. So looking on the individual names, you can go to the Singapore Exchange website and pull this up. I will show you the page for that later. But I just wanted to show a copy of this here so you could just scroll down and see which names are familiar. This is here in alphabetical order, page 1 and page 2, the 50 names. And now if you go to the website, you will see here with that and that URL up top. It's not too hard if you go up to derivatives futures. You can go to equity single stock futures and you can pull up the names of each of these individual names. So in this particular case, I pulled up Reliance, which is the top name in the index and also the one with the most listed single stock futures. You can see in the background here that it had a total volume of 10 contracts that day, an open interest of 60 contracts. I took this screenshot a little while back. It was on back in October. But you can see there are contracts with monthly expiration. So just like any other futures contract you might be trading, you can't buy Reliance shares in India, but you can buy these futures and then roll them on a monthly basis if you need to. If you wanted to get some more information on Reliance specifically, I like to look not just on a monthly basis, but I like to look long term. If you wanted to look at this particular company, you can see like a lot of single stocks, it's had periods where it's really run up and you would have made 10 times your money, and also periods where it's more or less gone flat. And what I wish I had for this particular name is more fundamental data where I would have been able to show you how the earnings per share follow these numbers, how the revenue followed these numbers. But there are different sources of data you might need to get when you do research on individual Indian names. This one here will show you the current EPS, the current dividend yield, current statistics, and so forth like that. But here for Reliance, you can see that if you've picked the right name and if you were able to roll it over the right period of time, you can get much better returns than you would get just by simply buying the index and taking all the other components that you may not want in it. So when I talk about fundamental data, you'll notice the earlier slide I went all the way back to the 1990s. The fundamental data in my One Worth database only goes back to usually about 2014, 2013. So this is data that you can get when you log into Interactive Brokers and you pull up fundamental data on the website. I have a similar Reuters feed, which I'm able to feed the One Worth database with, and that's where I'm able to do the EPS or the free cash flow per share numbers. So that's what you see if you go to this particular page and you see the link below to the page specifically for Reliance. Also on the One Worth page, I've done a year-by-year mark of the EBIT per share, debt per share, and equity book value per share of Reliance. So even though recently you saw that run up, you saw in the earlier slide that you have fairly steady earnings per share and growing free cash flow per share. But what you haven't really seen quite an exponential growth. So over this period of time, you've seen like a doubling, tripling of EBIT per share. You've seen a more gradual increase in book value per share, which has more or less been in line with rising debt per share. The reason I have these charts is that at a glance, I can get an idea of, is this company growing just by multiple expansion? Is it growing by real earnings growth? Is it growing simply by levering up and taking up lots and lots of debt? That's how I do research on individual companies, Indian or otherwise. And it's when I go here, this is where I realize I don't want to own every company in the MSCI India Index. I want to pick my 5 favorite Indian companies and just hold rolling positions in those. So, nuts and bolts, you've got an Interactive Brokers account, but you don't have an FPI license, you're not based in India. How do you trade the SGX-listed Indian single stock future and not the one traded on the NSE? This is where it can get a little bit tricky, because if you type in Reliance on your Interactive Brokers Trader workstation, you'll notice at first it'll tell you, oh, it trades on the NSE. You'll actually have to go here on this menu that pops up when you type in Reliance, NSE, click OK, and you'll notice down here there is a little menu. That little menu will actually let you choose SGX or NSE. So you'll notice the NSE futures trade in India and they trade in rupees and they have a smaller multiplier, whereas the SGX futures, as I'm going to explain shortly, trade in US dollars and they have a slightly higher multiplier. But that's what lets you trade them offshore without having an FPI license or access to Indian rupees. So if you ever get tripped up by this, just remember you got to type it in manually, and you've got to manually select this SGX exchange on the menu. If you've done this once on Trader Workstation for the 5 different contracts, and you choose, for the 50 different names, if you're going to look at all of them, and you choose the one with the infinity on there where it says Infinity November Continuous, that will always replace it to the current front month contract for you. Otherwise, it may be a little bit more tedious loading this for every single contract. If you're familiar with trading futures on the Interactive Brokers platform, this shouldn't be new to you, but we do this for clients all the time. So once you've pulled it up and you're ready to do a trade, what does a trade ticket look like? So this is what happens when I pull up the Reliance futures contract and I want to, let's say, buy one lot, buy one contract. Like all futures contracts, there's a multiplier of what the underlying is. At that time, Reliance shares were trading in India at around 2,932 rupees per share. But it's actually about half that because the multiplier is 20. So it's 1,468, you have to multiply that by 20. So that's why one contract, one lot, has a face value of $29,320 US per share. So you're taking the price in rupees, multiplying it by 20, and that's the face value in dollars that you're trading. Now, this is what's called a quanto. So you are getting exposure to the price of that stock in rupees, even though what you are trading is an instrument in dollars. So let's say if the rupee plummets tomorrow and the stocks rise accordingly, your futures contract will go up a lot as well, because you are buying a futures contract on the price of each share in rupees, even though your contract is settled in dollars. That is the main reason there is going to be a difference between the current spot price of those shares in India and the futures price. That's one of the basis that you have to look at. And that's another risk you have to watch out if you're going to be going long these futures contracts or short these futures contracts. But the reason I'm pulling this up right here is I want you to see what does this look like as far as a trade in dollars, and how does that affect your margin balance in dollars when you want to buy or sell one lot of these Reliance futures contracts. One thing I might add, though, is that even if you have an SPI license or even if you trade in India, this is also one of the few ways that you can actually short an individual Indian name, is with these offshore futures contracts. India is still one of the markets where it's very, very difficult to trade short positions. If any of you think I'm wrong on that, please let me know. I'd love to learn how else I can short Indian stocks. So, oops, where's that? Don't know if anybody can hear me. My computer is freezing up here. Hi, Cynthia. I'm not sure if you're there. My computer's frozen up. I can't get into the next slide.
Okay, what I'm going to try, Tariq, is actually let me grab the controls back for a moment, and I'll resend them to you. Are you able to move your screen?
Whoa. Doesn't look like it. Hold on. Don't have my cursor. Hold on. Where is it? Nope, I can't. Hold on. Yeah, I see your mouse, but I don't see mine. If you want to just, if you can pull up the slides, pull it up there, and we can just go to the last one. I can guide you through them. Sorry about that.
Okay, that's okay. We'll go ahead and what slide number? Oh, here you are. You were on this slide here.
Yeah, that one on your control. So I was just done with that slide. If you can go to the next one, I was just about to talk about differences between buying the stock ADR or P-note versus trading the single stock futures.
All right, go ahead.
Yep. Thanks, Cynthia. Sorry, everyone, for the interruption there. What I wanted to talk about now was what is the difference between, let's say you wanted to trade Reliance, and let's say you could choose all of these different methods. Let's say you had an onshore account in India and you could trade the stock directly, or you could trade the shares in London, an ADR, GDR, EDR there, or you had access to a bank that could offer you a P-note or an OTC derivatives contract. So the way that would work is you would buy it with cash. So if you wanted to buy $100,000 worth of it, you'd take $100,000 with it. If it's an ADR or GDR, EDR, you would be able to short it that way. You would not be able to short the shares in India or via P-note, as far as I know. You can, since it's a buy and hold, it's a stock, you can hold it as long as you wish. There's no expiry, there's no worry about having to roll it, and so on. You do also have Indian rupee FX risk. So that's whether you've converted your dollars to rupees and you're doing it in India via SPI license, or if you've bought Reliance shares in London, though you are owning shares of an Indian company, and if the rupee declines and Reliance's revenues don't go up accordingly, your shares are going to decline in value with them. In terms of dividend and tax issues, any dividends paid by an Indian company coming to you are also subject to whatever India's withholding rate is. That's, of course, going to depend on whether you're trading GDRs and if there's any withholding tax from where that is. That may or may not be significant, depending on which name you're trading, but that is something to keep in mind, because it is a cash transaction and money is actually crossing borders. Now, one thing with these is that these are still the developed and the liquid way of trading these 50 names. These 50 names are liquid in India. Those that have offshore ADRs or GDRs, those do trade fairly well as well. Now, how does that differ from single stock futures? Single stock futures generally have much smaller margin requirements. So if you wanted to trade for example, $29,000 US worth of Reliance, you wouldn't have to put up $29,000 US worth of cash. You could put in whatever SGX's margin requirement is for that single stock future and trade it with that. You can also go long or short equally easily. So I know this particular bullet, buy and sell easily, isn't particularly descriptive, but what I want to talk about was long or short are equally easy. So you don't have to worry on the short side about short selling restrictions or having to borrow or so on like that. One click, you are short the futures contract, you've got your short position on. Now, one disadvantage, depending on your strategy, if you're a long-term investor versus a short-term trader, the futures contracts do have to be rolled. So if this was, right now, December, and you buy the January futures contract, come January, if you want to keep your position, you have to sell your January and buy a February futures contract. That's going to mean some cost. That's going to mean some management on your side. That's, of course, one thing that keeps us busy in the futures that we manage in our accounts. For clients who are busy and traveling, they don't want to be able to watch futures contracts and roll them. The exposure, as mentioned earlier, is also a quanto, or you might think of as a hedged exposure, meaning you are trading the price of Reliance stock in US dollars. So you are not taking Indian rupee FX risk directly. So what does that mean? I mentioned earlier the case where the Indian rupee falls. Now, for some stocks, there are going to be some stocks where the Indian rupee falls and the stocks are going to fall with it. There are going to be others where the Indian rupee falls and those stocks will rise dramatically because they're exporters or they own real assets in other countries. Now, if those stocks rise, if you bought those stocks in rupees, that would be offset and you'd probably be flat. But if you bought these single stock futures contracts, the stock would rise and your futures contract would rise in dollars because you're not exposed to rupees. That's an important feature that can take a little while to get used to. Now, when I talk about dividend and tax issues, when you come to futures contracts, these are priced into a futures contract. Right now, it's December. If you buy the January futures contract and there's a dividend paid between now and then, the owner of the futures contract does not receive the dividend. The dividend is priced into that futures price that you trade at, and presumably whoever is taking the other side of that is pricing in whatever withholding tax or something that might be. Now, usually in my experience, net, that ends up giving you a lower effective tax rate than if you were to actually let the cash cross borders and be paid to you. The reason is the onshore hedger might be someone who owns the shares onshore, or it might be someone who's a short seller on the other side. So overall, from a tax point of view, that could be more efficient from you depending on where you're sitting. Last but not least, this is a disadvantage of the single stock futures, is that most of them are not as liquid as the individual names if you can trade them. Some of the names at the bottom of the list that I showed you earlier, you may put in a limit order and you may wait for days for it to get filled. Do not go in expecting to trade 10 lots of Asian paints, for example, and expect it to get filled right away. You might not find that much liquidity there. I sometimes have patience in how I put them in, and with some of these, I can be the largest trader on some of these names on a given day. So long as you acknowledge that the liquidity is developing, I'm hoping that we can start a virtuous circle where there's more and more trading in these names, and these can be a more active market. But one reason I highlighted Reliance earlier is that of these, it is one of the more liquid single stock futures on SGX. Next slide, please. So the next slide, we're talking about strategies. I was talking about one strategy where, let's say, for example, you had 5 of those names that you were especially bullish on and you believe was going to outperform the index. And this goes back to the title of this presentation, Beating the Benchmark. So you picked 5 components of the Nifty. Maybe you're weighting them equally weighted, or you're weighting them in some way that you think is going to outperform the index. But you don't want to take a view on whether the index overall is going to rise or fall. So the simple trade there is you buy those 5 single stock futures and you sell the India futures long short. And if you're right about outperformance, whether or not the market goes up or down, you would win on that futures trade. And if you were wrong, you're going to lose purely on a relative basis of your names underperforming the index. So what does this mean? Is that it does mean that you have to select the names. If you are doing it purely with futures, you don't have to worry about currency hedging. You don't have to worry about custody. You don't have to worry about dividends and taxation and corporate actions and all those other things. You're really just looking at prices of those futures contracts on the screen. Now, if you were to do the beta hedge, I was talking about hedging by selling the India futures. You could also sell an India ETF or so on, but know that if you do that, you've got different borrow and funding and currency issues that you don't have if you do everything with futures. by the way, with futures, there is also a Nifty Banks futures. So if you wanted to do it more simply, one trade I particularly like right now is going long certain non-financials and going short the financials. A light version would simply be to go long the India futures and short the Nifty Banks. You could also, if you wanted to, go long just a few 5 non-financial names and then short Nifty Banks. There are a few ways of doing that trade. So the risks of this trade are name selection. Namely, have you picked the right names to go long or short? I've given some examples earlier of some fundamental analysis or some fundamental metrics you might look at in deciding whether a company is rich or cheap. You also, of course, need to keep in mind the liquidity of the particular single stock futures you want to trade. As I mentioned, many of them are not as liquid as the underlying names or EDRs, GDRs, so that's something you have to trade off against the advantages of the futures. The other thing, as I mentioned a few examples of, are would a collapse in the Indian rupee result in a spike in the price of that stock, or would it not make as much of a difference? So the question is, does trading an Indian rupee asset in dollars work to your advantage or not? That means that you're going to have to be a little bit more careful on how you risk manage your shorts. But of course, if you ever take short positions, you know the importance of risk management on the short side anyway. Margin management is, of course, also something very important whenever you are trading futures contracts, whether it's these futures contracts, index futures, currency futures, what have you. So one little point that I wanted to include in here that probably was mentioned in documents, but since I myself am American and I know some given time zone, I'm imagining not too many U.S. attendees are dialing in right now. The SGX single stock futures are not directly accessible for U.S. customers, unlike the equity index futures or other SGX MSCI India net total return USD futures, which are CFTC approved. So just one thing to highlight there, again, I would defer regulatory questions to SGX or to Interactive Brokers. I really want to focus more on the economics and stock selection and fundamental questions, if I may. Next slide, please. So that concludes today's presentation on Indian single stock futures and how I believe it's possible to beat the benchmark by selecting good Indian single stocks, accessing them through those single stock futures, even if you don't have an onshore account or an FPI license. As mentioned, my name is Tariq Dennison on behalf of GFM Group Limited, based here in sunny, beautiful Hong Kong. You can see my website address here below, my email address, and my phone number, which you can access me on WhatsApp. I've also included my WeChat QR code, which, as you can see, I've probably left over from my previous China presentations. But please do feel free to reach out to me and ask me any other India questions you might have, or other questions about some of our strategies on the Interactive Brokers platform. Thank you again for attending, and I look forward to speaking to you again in future events. Back to you, Cynthia.
Well, Tariq, thank you very much for today's presentation. And as a quick reminder, I want to let you know that we have been recording today's event, and each of you will get a direct link to today's recorded playback, as well as access to the same webinar notes that Tariq has been using today. So do watch your inbox later on tonight for that update with the information. This will also be listed on the Interactive Brokers website. Underneath the education menu, you'll find the webinar section where you can locate today's presentation, plus a wealth of knowledge that Tariq has shared with us over the last several years. So with that, we are going to conclude today's event. Thank you all for participating. Have a great evening, and thank you, Tariq and the Singapore Exchange, for making today's event possible. With that, you can all exit today's session using the X in the upper right-hand corner of your screen. Thanks all.